Well, that is the question. Certainly equity investors don't think that's going to be the case.
Yeah, I mean, Operation Twist is, I think the impact is only pretty marginal, given that interest rates are already pretty low. And this is really a swap from the long end to the short end. And so it's really, it's not so much that interest rates are very high and that's a constraint, it's more that people are deleveraging. And so I think the problem that equity markets have is that they're now beginning to forecast a recession.
Well, no, I mean, with the way they've been dropping of late, I mean, it's not surprising that some could argue that they're actually almost pricing in a depression.
No. Depression would require like a 50% decline, and they're only down about 15 to 20%. But no, I think what's required now is absolutely overwhelming force by the policymakers in Europe and the U.S. And this is what Professor Bernanke was alluding to in his Jackson Hole speech. This is really almost beyond the Fed now. It's more for the policymakers to have a massive fiscal stimulus program in the near term with some indications of fiscal austerity later on.
Yeah. So it's a similar sort of thing. We're not getting the policymakers coming out in Europe or the US with a clear path to economic growth. It's, almost like, well, we're just trying to kind of whittle down what we have in terms of the debt pile. But hang on, surely the best way is to grow our way out of this.
Yeah, well, at this point in a democracy, you have enough smart people who begin to worry about the fiscal deficit and the debt, and that's legitimate. But at the same time, at this point in the U.S. 1937 or Japan in 1997, you had similar arguments, and you just cannot shrink your way into growth. And I think it's very difficult to handle a debt deflation or a balance sheet recession in a democracy. It just is very, very hard.
Well, of course, some stocks are looking very cheap out there, aren't they? But when they're cheap, it's for a very good reason as well.
Right. Now, I've been looking at Japan since the last 15 years, and Japanese stocks have become progressively cheaper and cheaper and cheaper, even though bond yields have been very low and the free cash flows have been improving. So I think what the market is saying is, yes, stocks are cheap, but we just cannot anticipate what the growth rate is going to be going forward, and that, I think, is the problem.
Okay, so what are we looking at specifically here? I mean, if you wanted to get involved with the equity market, where would you head to?
Well, I think, I made a tactically bullish call on the 22nd of August, I think it was here at that time, and I'm obviously going to review that given the new information from the Fed last night. So I think it's a very treacherous time, and I think the time for heroics is behind us. You just need to be a little bit careful out there without trying to be a hero.
Okay, let's just talk about some of the specific places. You're overweight China, Hong Kong, Korea, Thailand, and Taiwan, but non-tech.
Yeah, I think, for China, obviously it's been a disappointment because the inflation numbers have only now begun to come down. And I think they're probably keeping policy a bit too tight for too long. And obviously the U.S. and Europe are on the verge of recession, and then China really needs to stop tightening and perhaps even ease. So I'm anticipating that, although stocks haven't done that at all. I think Korea is looking interesting, although it's very cyclical, given that they have an undervalued currency. And so the smaller ASEAN markets, particularly the Philippines and Thailand, also looking pretty interesting to us. I think the key call now is what do you do with cyclicals versus defensives?
Ajay, and of course, got the one there slipping even further back as well, improving your prospects for growth, or should I say returns.